Good evening. Tonight is
Hello.
A one-to-one workshop, and I guess all the other participants will just access the video recording. But thank you very much for joining tonight. I'm not sure how to pronounce your name properly. Is this Naz? So
yes.
I will not feel lonely. And it's always better to have the feeling that I actually have someone listening to me rather than just talking to myself in my bedroom. All right, so tonight we I think this is not the first time. This is only the second time, I think, during our AS workshops. We are only going to focus on one topic. One PPT, but that's a big one. We need to talk about taxes and subsidies, which is the first topic that I generally teach when I start this new chapter on government microeconomic intervention. Sometimes I start with price control, sometimes I start with taxes and subsidies. Most of the time I start with price control because it is, I find it easier than taxes and subsidies. But I wanted for the workshops, I wanted to start with taxes and subsidies because it is a big topic that can that requires one full workshop to be covered. And after the holiday, for our last AS workshop, we will look at what's left to cover this third chapter on government microeconomic intervention, the price control. And also another topic, so I put together all the other instruments, privatization, nationalization. I'll say a few words about regulations. So I just call that other policy instruments. So that's what we will do after the holiday. Tonight, we focus on taxes and subsidies. So we'll need to give some basic information about taxes. What is it? What are the different types? What is the impact of a tax on the market equilibrium? Why do governments impose taxes? What are the main areas of government spending? We'll also see how we can use taxation to restore efficiency, to correct a market failure, especially to correct a problem of an over-provision in the case of a demerit good. And we also need, and that's the most probably complicated part of this topic, we also need to talk about the concept of tax incidence on consumers, tax incidence on producers, and see how the price elasticity of demand and supply have an influence on who really bears the burden of an indirect tax. We'll also say a few words about subsidies, but not that much because a subsidy is just a negative tax. So if we understand how taxes work really well, then subsidies will actually be pretty straightforward. But again, I will show what is the impact on the market equilibrium and how we can use subsidies to correct the problem of under provision, especially in the case of merit goods. So we have a lot to do, but for once, I am hopeful that the workshop will not last more than 2 hours. I actually think we can finish it, perhaps, hopefully, a bit before 9 tonight. All right, let's get started. Okay, so part one, introduction to taxation. I have introduced this drawing because it clearly shows what we call the different tax brackets. Each step is a tax bracket with a different marginal tax rate, because these are the marginal tax rates we see that here. And basically what we have here is a progressive tax system, a progressive tax where the marginal tax rate increases, but we will talk about that later in this part. As I said yesterday during the A2 workshop, it is often the easiest keywords that are the most difficult to define. So I like to start with a definition of a tax, because everybody knows what we call a tax, but it's difficult to give a proper definition. So that's the one that I like to use. So it's a mandatory, yeah, you don't get to choose. If you pay or not, you are required to pay. If you don't pay, well, then that's called a tax evasion, and that's illegal. So it's a mandatory financial charge. Yes, a tax is measured in terms of money. It's an amount of money you have to pay that is imposed upon a taxpayer. So the taxpayer could be either an individual, a household, or it could be a business, an organization. I think these are the two only types of economic agents that might have to pay taxes, businesses and people, basically. By a governmental organization. So this could be the central government, it could be a local government. Of course, there are different levels of government, so it doesn't really matter who imposes the tax. Income tax is usually imposed by the central government, the national government. Something like property tax might be imposed by the government of the city in which you live in. So it depends on the tax we are talking about. And yes, and this is something we have already discussed when looking at the determinants of supply. So I will move a bit faster on this because we've already had a workshop on this, the difference between direct and indirect taxes. So yeah, that's just a reminder. Direct tax on income or wealth, indirect tax on goods or services. Okay, and again, why do we call that an indirect tax? Because essentially, for example, if you take a sales tax, it is a tax that is imposed on consumption, basically. So consumers, they pay the tax, but they don't pay the tax directly to the government. They pay the tax to the seller, the business, or the retailer, for example, from whom they have purchased the product. And that company, that seller, collects the tax on behalf of the consumer, and then will simply transfer or give the tax to the government. So there is an intermediary, and usually businesses, they collect the tax on behalf of the taxpayer, and then they give the tax back to the government. All right, so that's why we call that indirect. And on the other hand, a direct tax is a tax such that the taxpayer directly pays the amount to the government. There is no intermediary. So for example, when you pay income tax, you directly write a check, or you directly transfer the money to the government. You do not go through an intermediary. That's why we call that direct or indirect. Okay, what are the main taxes in the UK? There are essentially at least four taxes, 5 taxes, direct taxes that students must know. Of course, the first one is the income tax. I don't think there is any issue with income tax. So it's a levied. So levied means that it's basically what is the tax base. The tax base is essentially what we use to calculate how much tax you have to pay. Okay, so income tax, the tax base is your income. So levied is just mean that is imposed on the income of individuals. Okay, corporation tax is the same thing, but now we are talking basically about the income of businesses and basically profits. Okay, you could regard profit as the income of businesses, how much money they generate, how much they have left once they have paid all their costs. So that's the equivalent of income tax for businesses. In the UK, there are the NICs, the National Insurance Contribution, which is a very important direct tax, which is a specific tax. Well, it's a direct tax, but it's specific in the sense that the tax revenue that is collected from the NICs are used to fund the NHS, the National Health Service, which includes sickness and disability allowances, state pension and unemployment benefits. So basically social protection. Okay, anything that relates to social protection in the UK is financed by the NHS, and the funds, they come from this direct tax that is known as the National Insurance Contribution. A tax that is imposed on wealth rather than income, because the 3 first example, income tax, corporation tax, and NICs, they are imposed on income. Inheritance tax is a tax that is imposed on wealth, and in particular the wealth that you inherit from a deceased person. Okay, so it could be a parent, could be an uncle, could be a brother or sister, could be a partner. If you inherit the estate of that person, then unfortunately you can't keep everything. You have to give a proportion, to pay a certain proportion in tax to the government. It actually depends on who you inherit from. If you inherit from your parents, usually the inheritance tax is extremely low, up to a certain amount. But if you inherit from someone that is a bit more distant in your family, usually the tax rate is much, much higher. So if you inherit from an uncle rather than from your parents, then the tax rate that is imposed is usually much higher. The capital gains tax is a tax that is imposed on your financial profit when you buy certain assets. So it could be a stock, for example. So if you buy a stock, if you buy for, you buy one stock. Let's take a simple example. You buy one stock at the price of $500, and you're very lucky. The price of the stock rises very much. So you sell it 5 years later, and it's worth $2,000. So we say that you have made a capital gain. So careful, because here the term capital doesn't really mean physical capital. Okay, it means financial capital. It means money essentially here. So in my example, our individual has made a capital gain of $1.5 thousand. And again, unfortunately, you can't keep that for you. If you make a capital gain, the government is going to take a certain proportion of it. So for example, in France, there is the capital gains tax is actually a flat tax, which means that it doesn't matter how much you gain. You can gain $1 or $1 million. You pay a constant capital gains tax of 33%. So you pay 1/3 of your. I don't know if it's 30 or 33%. It's either that, but so it's a flat tax. All right. Yes, same thing if you buy, let's say, a house. If you buy a house at for 1 million RMB, and 10 years later you sell it for 2 million RMBs, you've made a capital gains of 1 million RMB. You might have to pay some capital gains tax in some countries because the value of your asset, your house, has increased. Of course, it depends on the legislation. In some countries, you would not have to pay capital gains tax. In others, you will have to. The value-added tax, I don't really know how to define what definition to give for this course. The definition that I give here is a proper definition. It's a consumption tax that is levied on most goods and services, yes, repeatedly and at every point of sale at which value has been added, and that's why we call it a value-added tax. But I feel like this definition is a bit too complicated, perhaps for AS students, because when we talk about value-added taxes, we in fact we talk about a sales tax, but if we want to be precise, it's not the same thing. It's not exactly. It doesn't really work the same way. So I think I'm going to update the PPT slightly and just give the definition of a sales tax, which is just basically a tax on consumption. Okay, which is just a percentage of the price. That's maybe easier because this definition of value-added tax, which is accurate, is probably a bit misleading for some students and not very useful for the AS examination, because to my understanding in AS, when we talk about value-added taxes, we mostly just talk about the sales tax, but it's slightly different in reality. Okay, but yes, so we are now talking about indirect tax. Yes, of course. So VAT is the most famous one. In the United States, they call that the GST, the goods and service tax, which is definitely a sales tax or a consumption tax. We also have excise duties. They are indirect taxes, but they are not imposed on all goods. They are imposed on specific goods, and that's why we sometimes call that a specific tax. That's basically, yeah, because the value-added taxes, you pretty much have all good. You have to pay VAT on almost all goods and services. Could be at different rates. In China, I think there are 4 different VAT rates from, if I remember well, from 6% to 13%, depending on what good or what service you are dealing with. So it varies. In France, it's from 5.5 to 19 or 20. So again, it varies. They might be some goods on which you don't pay VAT. I don't have anyone in mind at the moment. But basically, yes, the VAT applies to pretty much all goods and services, and that's different from excise duties, which target specific products, and in particular, those who can damage consumer health or pollute the environment. Yeah, you see, there is something that I forgot to remove. It's about tariffs, because we can also talk about tariff. A tariff is an indirect tax that is imposed on goods and services that are imported. So it's also something that is relevant. Tariffs do not necessarily apply to all goods and services. You know that the tariffs can, again, target specific products. And the tax rate can be very high for some product if we want to protect domestic industries, if we want to discourage imports, and it can be very low if, for example, we have if we are talking about oil. I don't think there are many countries who have an interest in setting very high tariffs on oil. It's a raw material. It's very important for many domestic businesses. So if you do not produce oil yourself, you don't have a very strong incentive to set very high tariffs on oil. So of course it varies on, it depends on what you produce domestically, what you need to import, depends on the political relationships that you can have with other countries. And we've had a great example between the US and China. We also have a good example between China and Australia at the moment. So it's also quite political. Tariffs is not only about economics, it's also highly political. We will talk about tariffs when we study macroeconomics. There is a topic that is dedicated to protectionism, and therefore we'll have a much closer look at tariffs. But yes, it's also an example of an indirect tax that is imposed on some imported goods, and mostly goods, not really services, mostly goods. There are two additional indirect taxes. They are not very important, but it's good if your students can at least know the name and have a basic idea of what this is about. So the council tax is a tax that you pay when you occupy a domestic property. So a domestic property is a property in which you live. Okay, so if you live in a certain a house or apartment, you have to pay the council tax. And the business rates is another indirect tax that businesses paid by firms for the occupation of a non-domestic property. So like offices, for example, could be factories, could be offices, and for the occupation of those buildings, for those offices, they have to pay what we call the business rate. So it's also a tax on a good, and therefore that makes it an indirect tax. Okay, but really what really matters, income tax, of course, is very important. Corporation tax, it matters. NICs, I don't think I've seen it mentioned very often in the examination, but it's always good to know. I think inheritance and capital gains tax is important. I've seen that in a few MCQs, and it's especially important because these taxes are imposed on wealth, not on income, which is something that is quite interesting when we think about how we can redistribute wealth and not only income. For indirect taxes, value-added tax is of course the most common, but the problem with value-added tax, well, it's not really a problem, but it is value-added tax is not a per unit tax. Value-added tax or even sales tax, they are what we call ad valorem tax. And you know that in AS, we mostly focus on per unit taxes. Yeah, we do say a few words about ad valorem taxes, but when we analyze the effect that the introduction of a tax has on the market equilibrium, when we look at the tax revenue, when we look at the tax incidence, we don't really use VAT. We use specific tax, per unit tax, which is a tax that depends on the quantity that you buy, and it does not depend on the price of the product that you purchase. We'll see that in a minute. Okay, council tax and business rates are not that important. Okay, why do governments collect taxes? Good question. Do they just do that to upset households and to upset businesses? Well, of course not. The main reason is to fund government spending. Yes, we'll have a quick look at the main areas of government spending, but in order to complete its missions, its functions, the government needs funds, public funds, and therefore it needs to collect taxes to finance those main expenditures. Could be to provide goods and services, could be to give transfer payments. We'll have a look at the main areas of spending pretty soon. But it's not the only reason. It's not the only motive of taxation. Sometimes the government will impose a tax to correct a market failure. And so we cannot use taxes to correct all types of market failure. We can only use taxation to fix a problem of over provision. Basically, when the free market produces too much, or to put it differently, when businesses or firms allocate too many resources to the production of a particular good or service, there is an over provision, then yes, taxes can actually restore efficiency, make the market more efficient, and make sure that businesses will allocate the right, or the best, the optimal amount of resources. So for AS, there is a single situation that is of interest for us, which is the case of demerit goods. Yes, when we have a demerit good, like alcohol, could be tobacco, could be a junk food, we know that consumers, they purchase too much demerit goods, and taxation can discourage consumption, and therefore at the end of the day lead to a lower level of production. So we can fix the over provision. Externalities, negative externalities, is also a type of market failure that we can fix using taxation. However, externalities are not part of the AS syllabus, they are part of the A2 syllabus, and therefore we'll not talk about that in today's workshop. We can also use taxation to redistribute income and wealth, and there is one particular type of tax that is suitable when we try to achieve that objective, is the use of a progressive tax. So we'll see what a progressive tax is, but progressive taxation is one way to impose a higher tax burden on high income households and a much lower tax burden on low income households. So that's one way to reduce after tax income inequality, or even wealth inequality as well. Make sure that wealth inequalities do not replicate generation after generation. Typically, inheritance tax is one way to reduce wealth inequalities between generations. And finally, if we take a more macroeconomic perspective, taxes can be used to manage the economy. So I'm basically thinking of fiscal policy. Fiscal policy has two possible instruments: government spending and taxation. So we can either increase taxes or decrease taxes to implement an expansionary or contractionary fiscal policy and to influence the economy. It could be inflation, could be unemployment, could be economic growth, could be the trade deficit. So all those economic variables that matter to a government, they can be influenced through changes in tax rates. Okay, so we have the four main reasons for which governments may want to collect taxes or to impose taxes. And here we have this pie chart which shows the total income that has been received by the government through taxes. So that's the total tax revenue in the UK in 2020. So it's pretty up to date. And that gives you a pretty good idea of what taxes are the most important in the UK. So basically income tax, you see that it's roughly 25%. If you add the NICs, the National Insurance Contribution, we have more than 1/3 of total tax revenue. If we add the corporation tax over there, for now I'm starting with direct taxes. Okay, so income tax, NICs, corporation tax, and that's it for the direct taxes. We have pretty much 50%. So it's a pretty good rule of thumb. You can say that in the UK right now, you have about 50% of the total tax revenue that comes from direct taxes and 50% that comes from indirect taxes, even though here what we have other taxes is a bit unclear. All the non-taxes, honestly, I'm not exactly sure what's inside. I don't know if we are talking about indirect taxes or direct taxes. But given the information that we have roughly 50% that comes from direct taxes. Then for indirect taxes, we have the excise duties over there. We have VAT. We have the council tax and business rate. So you see that all the taxes that I have mentioned before, they are there. So your students should be able to explain all, or to know, at least to know what each tax is about, to be able to determine whether it's a direct or indirect tax, and to know what it is levied on. What do we tax? Do we tax income? Do we tax wealth? Do we tax the occupation of a domestic property? Blah, blah, blah. Okay. Now, the government has collected taxes. What is the government going to do with it? So it's important to identify the main areas of government spending. So again, I collected some data from the UK, but let's start first with general consideration that can be applied to any country. In many countries, especially Western countries, there is a big chunk of tax revenue that is used for what we call social protection. You can call that welfare benefits. So these are transfer payments that are given to mostly people, not really businesses. Yes, so it's transfer payment to individuals, to households that are vulnerable. So vulnerable because they don't have a job, they are unemployed, vulnerable because they have a disability, vulnerable because they have like a long-term sickness, vulnerable because they have retired and therefore they no longer earn an income from a job. So in that case, the government will give them transfer payments just to make sure that they can maintain a decent standard of living. The second area of government spending that is quite important is the provision of public goods. We have studied public goods, and we know that private businesses have no incentive to produce public goods. And the main solution, the most important solution to make sure that public goods will actually be produced is for the government to provide public goods. But of course, it's costly. So we need to collect tax revenue, and the government will use some of this tax revenue to provide national defense, public order, safety, and other public goods as well. Street light, because we always give the example of street light as well. Asteroid defense, that's the example that I used as well. Another area of government spending could be the provision or subsidization of merit goods, because again, we know that when there is a merit good, the market will not allocate enough resources to produce merit goods, simply because consumers, they don't see the full benefit associated with the consumption of merit goods. Therefore, they will not demand enough merit goods. Therefore, the equilibrium quantity will be less than what it should be, less than optimal. We will have an under provision. So in that case, there are two solutions for the government to try to make things better. Solution one, just to produce more merit goods by itself. So it could be, let's build a public school, let's build a public hospital. So that's one way to increase the quantity or increase the supply of merit goods to make sure there is enough for everyone. That's also one way to decrease the price of merit goods to convince more people to consume more merit goods. Or it can simply give subsidies, which pretty much has the same effect. Okay, either we can do it ourselves, or we can give money to private businesses to encourage them to produce more merit goods. But in both cases, it requires public funds. And therefore, that's one area of government spending. This is one way the government can spend some of the tax revenue it collects. Could also be the provision of infrastructures. And actually, that's another example of market failure, which is not really market failure, but it's a specific type of industry that we call natural monopolies. There are some industries in which the startup cost is so high, where especially in network industries, like electricity, could be roads, could be the gas network, could be the water network, any network industry, could be the internet cables as well, has a huge fixed cost, because before you can actually use the infrastructure, well, you need to build it, and it usually costs billions of dollars. And in most cases, just more efficient for one single business to produce it, rather than having many businesses producing their own network. Can you imagine if we had 5 different railway networks, each of them operated by a different railway company? If we had 5 different networks of electricity lines, that would be a pretty big mess, right? And it's just not efficient. It's just such a waste. It's clearly more efficient. If we want to avoid wasting resources, it just makes more sense to have just one single organization producing the network, and then selling providing the service. Because when we talk about network industries, we mostly talk about providing a service, like providing electricity, or providing water or gas, or even transportation infrastructures. It's just more efficient to have just one business providing the service for everyone. So basically, it's more efficient to have a monopoly, which is sometimes a bit counterintuitive, because we know that monopolies, they are usually pretty bad, especially for consumers, because they face no competition, and therefore they usually take this absence of competition as an opportunity to charge higher prices. And well, we will see in A2 that this leads to a pretty bad situation in terms of economic efficiency. And monopolies, they typically create a pretty big deadweight loss because of their market power. And that's why, in that case, we want to avoid that situation. We don't want to let one private business produce and operate the electricity network, the gas network, water network, transportation infrastructures, and so on. So what the government usually does is that the government does it itself. It provides those infrastructures itself. So it's a public monopoly. And because it is a public monopoly, it makes sure that it doesn't charge a price that is really high, simply because the objective of the government is not to make the highest possible profit. At least that's the assumption we make in economics. The objective of the government is to maximize total surplus. So a public monopoly is likely to charge a much lower price than a private monopoly. Okay, so that's basically what we call a natural monopoly, those industries in which it is much more efficient to have just one business producing for everyone, but we don't want to let a private business do so because we are afraid that the price would be too high. So instead, the government takes over the entire production. Of course, there are some operating costs. Okay, there are some, we have to build some offices for the civil servants, so for those working for the government. It just costs money to run a country. Of course, it's not free. You have to pay those who work for the government, the transportation. Well, there are many operating costs, obviously. And one last that we often forget, but that is actually pretty significant, it's the debt service. What is it? It's simply to pay the interests on the public debt. Okay, pretty much all countries in the world, with very few exceptions, they have accumulated a debt. All governments have accumulated a public debt, and of course, they will have to reimburse definitely after some time, but they also have to pay interest payments, to make interest payments to those who own the debt. It could be government bonds, for example. Okay, if you own a government bond, you will receive an interest payment from the government every year. And this costs a lot of money, especially, and the larger, the more important your public debt is, the more you have to pay every year. And you'll see that this is not a negligible amount, at least in the UK, but it's true in most countries. All right, so these are the main areas. Okay, it's not very, very precise, but I wanted to keep it simple and to keep it related to what we have studied. Okay, so basically social protection is about fairness, income, reducing inequality. Public goods is a market failure. Public goods, market failure. Married goods, another market failure. Infrastructures, it's also a market failure caused by those natural monopolies. Operating costs, well, of course, that's just a natural thing when you run a business. And the debt service, it's also something that that should definitely be considered. Same thing, I collected some data from the UK. So this is the public sector spending in the UK over the fiscal year 2020-2021. And again, you see that the biggest chunk is social protection. So again, social protection, what does it include? I think unemployment is it? Yeah, it does in person. Yes. So basically, a social protection would be unemployment, disability, sickness benefits, state pension. So you see that's a pretty big chunk already. So healthcare, okay, that's also, honestly, I'm not sure if sickness benefits, if this is included in health or not. I don't know whether they consider, whether they consider that part of social protection or they consider it part of health. I'm not sure. Personal social services, I'm not sure exactly what this is. Transportation, so the infrastructures. Education, you can see, regard it as a married good, just like health. Okay, healthcare, education, so married goods. Transportation, public monopoly. National defense, public good. Industry, agriculture, and employment. And then, well, of course, you have many smaller components. Public order and safety, that's another public good. And I don't know exactly what they mean by housing and environment. Could be to fix a problem of negative externality for the environment. Housing, I don't know, this could be to subsidize housing for low-income households. So this could be to reduce income inequality. I'm just guessing, okay? I'm not telling you that this is the case. I'm trying to guess what can be inside. Industry, agriculture, this could also be probably some subsidies, some assistance to domestic firms. So this could be, for example, to protect those infant industries, or this could be to make domestic companies more competitive, to avoid a trade deficit that would be too large. If you subsidize domestic industries, this is one way to make sure that you don't rely too heavily on imports. And especially for agriculture, you know that this is very important for a country to be able to produce its own food, not to rely on other countries to feed the population. So this would make sense. This would make sense that the government subsidizes agriculture to remain self-sufficient. Okay, so same thing. I think it's an interesting pie chart that gives good information about what we can do with the tax revenue. And you see debt service, the debt interest, 56 billion in 1 year, which is the same budget as national defense. So in last year in the UK, they spent as much money on national defense than what they spent just paying interest. They're not even paying back, right? When we pay interest on the debt, we don't even pay back. We just pay the interest on the public debt. And can you imagine with the COVID-19 pandemic and the public debt of most countries that is just skyrocketing, you can expect that the debt service, the debt interest is going to increase pretty significantly in the future. Okay. Let's talk about the 4 canons of taxation. And honestly, I don't really like this word canon because nobody really know, at least doesn't make sense to me very much. Apart from that context, I can't recall having seen that word anywhere else in that context. I would just replace it by the 4 principles. Okay, the 4 principles of taxation. And what is it? So yeah, this is something that was identified by Adam Smith in his most famous book, The Wealth of Nations. And well, the 4 canons of taxations, that's simply 4 characteristics that any good tax should have. Just like when we talked about money, we talked about the characteristics of money and we identified some desirable characteristics that money should have. Should be transportable, should be durable, should be, well, I don't even remember now. It's hard to counterfeit. And identical, so if you take 2 different units of currency, they should be exactly the same. And okay, that's the same thing for the canons of taxation. If you introduce a tax, there are some basic characteristics that a good tax should have. And those 4 canons are equity or fairness, certainty or transparency, with in different, depending on the source you use, you can see the 2 names, convenience, and economy. So for this presentation, because I remember that when I prepared this PPT, I spent a pretty long time reading a lot of information from different books, from different websites, from different videos to find the best way to explain what each canon is about. And I ended up keeping things very simple. And I think it's definitely sufficient, and at least it's very clear. To me, it's very clear. So the canon of equity or fairness, it's about imposing taxes in accordance with the principle of ability to pay. So if you have more income, so you can pay more, you should pay more. And besides, if you have 2 individuals that have the same income, so they have the same ability to pay, they should pay the same amount. We sometimes call that vertical equity and horizontal equity. Horizontal equity is the idea that if you have 2 persons who have the same financial situation, then they should pay the same amount. Okay, it would not be fair to ask one person to pay much more than the other if they have the same, if they have the same income, wealth, and so on. So we call that horizontal equity. Then you have vertical equity, which is about if you have one person that is quite poor and one person that is rich, of course, the person that is rich should pay more than the person who is poor, okay? And then how much more? Of course, it depends because fairness is something subjective, but I think we all agree that if I make $1,000 per month, and if I pay $200 in tax, and if someone makes $10,000 per month and pays $500 in tax, so it's still more than what I pay, but it's not much more, okay? This person makes 10 times more income that I make and only pays 5 times more taxes than I do, then most of us would regard this as not fair. And in that case, we would say that the tax is not vertically equitable. So yeah, you can talk about horizontal and vertical equity. So yeah, a tax should be fair, basically. Second, the tax should be certain or transparent. So certainty, transparency, it's just about information. Basically, do you understand it? Do you know what you have to pay, when you have to pay, to whom you have to pay, how you have to pay? Is everything clear? Okay, or is it easy to calculate your tax liability? Do you know exactly? Well, you get the idea. You should have very clear information about your tax liability and the process to pay your tax. Convenience is about, is it easy or complicated to pay your tax? So yeah, a good tax should be levied in a manner that is convenient to the taxpayer. Okay, we should not spend 2 days filling some tax forms, calculating how much income we have made in 1 year, double checking if all the information is there. Okay, that's not convenient. A good tax is something that is painless, not for your bank account, but at least you don't spend time and energy, you don't allocate productive resources just to pay your tax. The best example is an indirect tax like VAT. When you pay VAT, you don't even realize that you pay a tax, you just pay, and part of the price you pay is a tax. So that's very convenient. Direct taxes like income tax, they tend to be less convenient because yes, every year you have to fill some tax form. So now with the internet, it becomes much faster, much more convenient, but still, it usually takes at least some time to pay your income tax. And same thing for corporation tax. Well, I don't have a business myself, so I don't know how convenient it really is, and I guess it depends on countries. But again, I guess it's probably something that is quite complicated for you to declare your profits, to declare all the different types of income that you may have received, to be able to calculate your tax liability. And that's why I guess most businesses, especially larger businesses, they actually hire accountants to complete or to declare their taxes. The last one, the canon of cost or economy. Yes, so you can use both terms. It's about the cost of collecting the tax, because yes, collecting the tax is not free. You need to design the tax, you need to enforce it, you need to give information to the taxpayers to explain to them how it works. You need to hire people who will collect the tax. So again, make sure that everybody has indeed paid the right amount, maybe to assist people who don't really know how to proceed. So it's costly for the government to collect a tax. So a good tax is a tax that is cheap in the sense that it does not cost you too much to collect it. Because of course, if you have a tax that generates a tax revenue of $1 billion, but if it costs you $500 million to collect it, well, it doesn't look very great, right? So it has to be as cheap as possible. Okay, so it's pretty easy, right? 4 characteristics of a good tax. Each characteristic is known as a canon. Now we are ready to talk about the different tax systems: progressive taxation, regressive taxation, and proportional taxation. And to do so, it's important that we distinguish between the average and the marginal tax rate. And so let's just say a few things about that. That should be rather quick because, students should already have a pretty good understanding of what we mean by average and marginal. But let's just start from the top. What we can call the total tax is the total amount we pay. Easy. Okay, so income tax, you have an income of $10,000, you pay $2,000, boom, the total tax is $2,000. The average tax rate is just a share of your income that you pay in tax. So again, if I have $10,000 of income, I pay $2,000 of income tax, then my average tax rate is 20%. 2,000 divided by 10,000. So just the total tax divided by my income, my taxable income, simply. Graphically speaking, it's important to know, even if there are not so many questions about that, but you can just mention it, that the average tax rate, graphically speaking, it measures the slope of the line drawn from the origin to the total tax curve. I'll show you that in the diagram in a minute. The marginal tax rate is different. The marginal tax rate is the share of the last dollar of income that is paid in tax. Example, let's say that when my income was $9,999, let me write it because otherwise it's going to be a mess. Okay, so I said that when my income is $10,000, then I paid a total tax of $2,000. All right. And let's just say that when I had 9,999, I paid a total tax of, let's say, 1,999.8, something like that. Okay, so I see that the last dollar of income, okay, when my income increased from 9,999 to $10,000, my total tax has increased. Oof, that's way too big. My total tax has increased by basically 20 cents. Okay, and this increase in total tax is what we call the marginal tax rate. So you see that this is the share of the last dollar of income earned that is paid in taxes. So in my case, my marginal tax rate is 20%. The last dollar of income that I have earned, I kept 80 cents and I gave 20 cents to the government. So that's a 20% marginal tax rate. And it's very important to distinguish between the marginal and the average tax rate. And I will show you an example when we look at the actual tax brackets in the United Kingdom. Okay, and again, graphically speaking, it's important to know that the marginal tax rate measures the slope of the total tax curve. And in general, this graphical relationship between the total, the average, and the marginal is not only true for taxes, it's also true for cost, for revenue, for utility. Anytime for production, anytime there is a total something, average something, marginal something, you will find the same graphical relationship. The average is the slope of the line from the origin to the curve, and the marginal is the slope of the total curve, always. And a tax system, yes, there are essentially three different tax systems, or you could say that if you want to put it differently, you can say a tax can be either progressive, regressive, or proportional. And this is a very important slide, and they are a very typical mistake that students really have to avoid. When you define a progressive tax system, the definition is simple. It's a tax system in which the average tax rate rises with income. So it's true that it means that the more income you have, the more tax you pay. But this is not what makes it progressive. What makes it progressive is that the more income you have, the larger the share of your income that you pay in taxes. Okay, when you look at a tax system, and if you want to determine whether it's progressive, regressive, or proportional, it's not about the relationship between how much you pay in total and your income. And in particular, if you look at those three tax systems, it doesn't matter if you look at a progressive, proportional, or regressive tax system. In all cases, the more your income you have, the more tax you pay. So that's not how you can distinguish them. What distinguishes them is that in the progressive tax system, as I said, the more income you have, the larger the share of your income that you pay in taxes. In other words, the average tax rate rises. In the proportional tax system, it doesn't matter what your income is. You pay the same share of your income in taxes. Okay, it could be 20%, regardless of what your income is. And in a regressive tax system, the more income you have, the smaller the share of your income that you pay in taxes. So that's a very typical mistake. There are many students who will write in a regressive tax system, for example, those who have more income pay less tax. No, even in a regressive tax system, those who have more income, they pay more tax. But the tax rate decreases. The average tax rate decreases. And we'll see, I'll show you an example that indirect taxes tend to be regressive. And I will explain why. So this is how you can represent the various tax system, but for now it doesn't really matter if it's progressive or regressive. I just wanted to show the relationship between the total tax, the average tax rate, and the marginal tax rate. So this curve represents my total tax curve. Okay, so as my income rises, the total tax that I pay rises, apart from very low incomes, because usually people who have very, very low income, they don't pay any income tax. Okay, they only start paying income tax once their income has reached a certain threshold. And then you see in that case, it seems like my total tax increases, of course, but at an increasing rate, increasing and convex. And this is a characteristics of progressive taxes. How can I identify the average tax rate at for this level of income, for example? So if I make $Y0 of income, I will have to pay a total tax of TT0. And if I look at the slope of the tangent, okay, so the slope of the TT curve, and I look at the gradient of this tangent, then that's my marginal tax rate. And you see that, of course, because this total cost curve increases at an increasing rate, this suggests that my marginal tax rate rises, which is again a characteristic of progressive taxes. If I want to see the average tax rate for this level of income, I just draw a line from the origin to this point, just like that. And same thing, the gradient of this line is the average tax rate. And again, you can see very clearly that this average tax rate increases as we increase income. Okay, if you take this level of income, the average tax rate is 0. If you take this level of income, you see that this line is going to be very, very flat, low average tax rate. And as I move up along my total tax curve, of course, the angle or the gradient of this line opens up, widens. This angle becomes larger and larger, which indicates that the average tax rate rises. So we are dealing with a progressive tax. You can also represent it like that, but this is not necessary. I think I should have added a one step further star. But basically, yes, what is interesting is that when you have a progressive tax system, the average tax rate rises with income, and the total tax increases at an increasing rate. Okay. The marginal tax rate also increases and should be above the average tax rate, but that's not very important. In a proportional tax system, the total tax increases at a constant rate, okay, because the average tax rate and the marginal tax rate, they are constant, okay. So this would be the representation of a proportional tax system. It should go through the origin, careful. If it does not go through the origin, you will not have a progressive tax system. Be careful with a proportional tax system. So here, what matters is that it increases, yes, but it's true in any tax system, but it increases at a constant rate. And in a regressive tax system, it still increases. So you see that in all tax systems, the more income you have, the more you pay in taxes. But here it increases at a decreasing rate, increasing and concave, which means that your average tax rate, as well as the marginal tax rate, they both decrease, as represented in the bottom diagram. And you can remember that, yes, the marginal tax rate will be below the average tax rate. And this is what is going to take the average tax rate down. Okay, so you see the difference: increasing and convex, progressive; increasing and linear, proportional; increasing and at a decreasing rate, concave, regressive. All right, this is the income tax system in the UK. So I haven't updated the data since last year, so this has probably changed a little, but not significantly. what we call the personal allowance. It's the part of your income that is not taxed. So which means that the part of your income that from £0, or to put it differently, the first £11,000 that you make, you don't pay income tax on that part of your income. You start paying income tax on any income above £11,000. And you see that you have different brackets. You have 3 brackets in the UK, the basic rate from 11 to £46,000, the higher rate from 46 to £150,000, and the additional rate for those on very high incomes. And there is, again, a very typical mistake, and not only for students, for many of those who actually pay income tax everywhere in the world, they assume that these tax rates are the average tax rate. Okay, so they will say something like that, oh, if I make £50,000 of income, then I will pay 40% of £50,000. It's a lot, right? That would be a lot. And of course, it's not the case, because what we have here is these are not the average tax rate, actually, apart from the personal allowance, because for the personal allowance, this is the average and marginal tax rate, but it doesn't really matter. But for the basic rate, higher rate and additional rate, 20%, 40%, and 45%, these are not the average tax rate. These are the marginal tax rate. And it's very funny because I remember 2 years ago, there was a WeChat article that explained how to calculate your tax liability in China. So there was like a long article that looked very, very professional. And they gave information, they really gave the same type of table where you had the different tax brackets for income tax in China. And they just said, they just made the mistake that I just described. They say, okay, so just look at where you are. Just look at in which bracket your income belongs, and just multiply it by the percentage that you see there, and you get your tax liability, which is, of course, completely wrong. So what I like to do with the students is usually to take an example. So I have not added an example in this PPT, but let's do it together. Actually, I don't have the pound symbol on my keyboard. Okay, let's just say dollars. Okay, I don't know how to type pound on my keyboard. What if I make £50,000? Doesn't matter, dollars. How much income tax do I have to pay? So again, the mistake that we have to avoid is to say, okay, I will have to pay £50,000 and it belongs to this brackets time 0.4. Okay, so that would be $20,000 or pounds. Okay, is this what I have to pay in income tax? Well, of course, that's what we can be tempted to do, but of course, this is a mistake. Okay, actually, I'm going to put it. Okay, no way. That's not how you calculate your income tax. What we have to do is to calculate it part by part. So what do we have? We know that on the first 11, I'll just round it, okay? On the first £11,000 of income, I pay 0%. It's like a gift. Okay, so that's good. Then from on all the income that I made from £11,000 to £46,000, so how much is it? £46,000 minus £11,000. Okay, I pay the marginal tax rate of 20%. Okay, and I still have some income left from £46,000 to £50,000. So how much is it? It's like £4,000. Yes, £46,000. I face a marginal tax rate of 40%. Okay, and my tax liability is the result of this formula. and I don't have a calculator, so I don't know. But this is how you calculate your tax liability, your income tax liability, using this type of table that shows the tax schedule of the tax bracket. So make sure that your students, that you avoid making this very, very common mistake, because yes, it's very tempting to just mix average and marginal tax rate, and that's why it was important to distinguish them. Good. Okay, so progressive taxation, what's good about it? What's good about progressive taxation is that it is one way you can redistribute income, or at least it's one way you can reduce income inequality or even wealth inequality. You can narrow the gap between high income and low income households. Why? Simply because progressive tax, because those on high income, they have the burden of the tax is heavier for those on high incomes because they face a higher average tax rate than those on low income. It's one way to make sure that the tax you collect has a much higher incidence on rich people, basically, than on poor people. And at the end of the day, why does it reduce income inequality? And what we mean by that, because it's not very clear in most books, but what it means is that they are progressive taxes. They can make sure that disposable income inequality, so which means income inequality after we have paid taxes, is much lower than gross income inequality. Okay, so gross income is before we pay taxes. So some people make a lot of money and some have almost nothing, very big inequalities. But after everyone has paid income tax, for example, a progressive tax, the inequality between disposable income, what people have left after they have paid direct taxes, is much lower. Yes, so that's why in many countries we believe, but remember, fairness, equity is something subjective, but in most countries, progressive taxes are believed to be more equitable, more fair than proportional and regressive tax systems. But progressive taxations are not perfect. And usually there is something that is typical, which is a trade-off between efficiency and equity. Progressive taxes, they are good to improve equity, to improve fairness, but they create some inefficiencies. They have some problems. One, a problem that can arise due to progressive taxation is what we call the poverty trap. So it's mostly an A2 concept, but I've seen it mentioned in some textbooks for AS. So I felt that this is important to just mention. So the poverty trap is a situation in which you have lower incentives to work more, to take a job, simply because you anticipate that if you work more or if you take a job, you will receive more income. Okay, but if you face very high marginal tax rate, the additional income earned will be taken away by the government, maybe not entirely, but a big proportion, a big fraction, a big share of the additional income that you earn by working more will just be taken away by the government. So in that case, is it really worth it to work more? Is it really worth it to take a job if you cannot keep most of the additional income that you generate? Maybe not. So this disincentive to take a job is known as the poverty trap. This might also, especially for rich people, if they face very, very high marginal tax rate, they might undertake tax avoidance or tax evasion. But what these two things have in common is that the objective is to pay less tax, to reduce your tax liability. The difference is that tax avoidance, it's legal. It's a bit borderline, but it's legal. Tax evasion, it's illegal. Tax evasion would be to hide your money somewhere or to lie when you fill your tax form. So you take illegal actions, you engage in illegal actions in order to reduce your tax liability. Tax avoidance is usually trying to find some loopholes in the tax system, to find some tricks to reduce your tax liability. Could be something like registering your house to your company's name, or giving some of your assets to your children. Again, I'm not an expert, but you try to find some ways to reduce your tax liability in a legal way. You just try to be smarter than the tax system to pay less tax. And rich people, they often hire accountants or fiscal consultants to reduce their tax liability. In French, we don't call that tax avoidance. I like the French word better. Actually, we call that sorry, I forgot it in French. Okay, we call it fiscal optimization. That's very elegant, right? Fiscal optimization, which means you minimize, so you optimize your tax liability. You can also have, that's the last limitation of progressive taxation. You can have a situation where if progressive taxation is just too hard on high income households, people might just choose to vote with their feet, which just means to go somewhere else. Okay, if taxes are too high in the UK or in France, they will just go to Singapore. They will just go to a tax haven. So tax haven is just a place where, well, taxes are very low, taxes on businesses or taxes on people. So this could be individuals voting with their feet, leaving, or could be businesses that will just locate their headquarters or their activity to a tax haven to reduce their tax liability. And some people, but it's very controversial, but some people believe that this might undermine what we call trickle-down economics. Again, it's quite controversial, but the idea is that if you cut taxes on businesses and if you cut taxes on very wealthy people, then they will have more disposable income. So they will be able to spend more profit for businesses, so they can invest more, they can hire more people, wealthy people, they can spend more. And the idea is that because wealthy people can consume more, businesses can invest more, hire more, this eventually benefits the entire economy. Okay, but if you tax them very much, businesses don't have a lot of profit left, so they can hardly invest more. It's difficult for them to hire more workers, and wealthy people, they are not able to increase their consumption very much, and therefore this cannot benefit the entire economy. This theory doesn't make much sense, at least for individual, because we know that very wealthy people have a very low marginal propensity to consume, so it doesn't make much sense. For businesses, it's more questionable. All right. Something interesting about indirect taxes, because we often say indirect taxes are regressive, yes, but we don't often explain why they are regressive. So let's use an example. And the key idea here is that indirect taxes tend to be regressive, like a sales tax, because the average propensity to consume decreases with income. The average propensity to consume is the proportion of our income that we spend on consumption. And people who are very, very poor, they spend their entire income on consumption. Basically, once you have paid your direct taxes, you have your disposable income, and you can use your disposable income to consume or to save. Okay. If you are very poor, you will not be able to save much, so you will consume maybe 95% of your income. So your average propensity to consume is going to be 95%. But if you are very rich, you can afford to save a much larger proportion of your income. So you might consume only 50% of your income. So your average propensity to consume is 50%. And yes, basically, since I'm in China, for example, compared with my situation in France, my average propensity to consume has very much decreased. And my average propensity to save has very much increased, of course. And some data from the UK about indirect taxes, just to stress that, yes, indeed, indirect taxes are definitely regressive. if we focus on yes, all indirect taxes in 2017, the poorest fifth of households, so the 20% of the population with the lowest income, paid the most as a proportion of their disposable income on indirect taxes, 30%. So if you take the 20% of the UK households who have the lowest income, just them, they paid close to 30% of total indirect taxes. And if you take the top 20% of the UK population, those on the highest income, they only paid close to 15%. So basically, you see that the tax burden, the burden of indirect tax on poor people is twice as heavy as the tax burden on the top 20% of the population. So that's these data clearly indicate that indirect taxes are very much regressive in the UK. Okay, how can we make sense out of it? Here's an example, and let's focus on VAT in the UK. And the standard VAT rate in the UK is 20%. And let's take two individuals, two households. We have Jimmy, and his monthly income is £1,000, and his average propensity to consume, APC, is 90%, 0.9. That's just an assumption. So how much VAT does he pay? So he will spend, he spends 90% of his income on consumption. So he will consume for £900 every month, and he will pay 20% of £900, which is £180. Okay, so we can calculate his average tax rate. So the total tax that he has to pay divided by his income, £1,000, 18%. So Jimmy, which has a low income, faces an average tax rate of 18%. If I take now Amy, which is definitely richer, she makes £5,000 per month, then her average propensity to consume is only 0.4 because she can afford to save much more, 40%. So 40% of £5,000, that's $2,000. So she's only going to spend $2,000 on consumption. And because the average tax rate is 20%, if she spends £2,000 on consumption, she's going to pay £400 in VAT. Okay, easy calculation. So we can calculate her, and you see it's more than Jimmy, right? Jimmy paid £180 and Amy pays £400. But careful, this does not mean that indirect taxes are regressive, because remember, the total tax always increases with income regardless of the tax system we consider. We have to compare the tax rate, the average tax rate. And Amy's average tax rate is only 8%. Jimmy, remember, was 18. So you see that Amy, which is much richer than Jimmy, faces a lower average tax rate. So indeed, we can see that VAT is regressive. How can we explain it? Well, this is simply because Jimmy will pay VAT on 90% of his income, and Amy will pay VAT on only 40% of her income. And that's why indirect taxes are regressive. It is as simple as that. All right, you have the explanation. So Jimmy pays less. This does not mean that VAT is progressive. We have to compare the average tax rate. And yes, VAT accounts for a larger share of Jimmy's income. That makes it regressive. Okay, do you have any questions up to now? Or are we good? Are we ready to move on? Are we good? Okay. All right, so we don't have much left to do. Well, in terms of content, because for this introduction, we covered a lot of very different topics. Now it's just more straightforward. So what happens when we introduce indirect taxes in a market? So what we have to do first is to distinguish between a specific tax that we also call a per unit tax and an ad valorem tax. Specific tax is just a tax whose amount is proportional to the quantity or the volume that we buy, and the price doesn't matter. So for example, an excise duty of $2 per pack of cigarettes. Okay, it doesn't matter if the pack of cigarette is $20 or $10, $5, just a certain amount per unit. And that's why we call that the per unit tax. And an ad valorem tax does not depend on the quantity we buy. Well, yeah, it does, but what I mean here is that it's not proportional to the quantity, it's proportional to the price. So it depends on the value. And in Latin, valorem means value. So that's why it depends on the value of a good or service. So if, for example, 20% of the price. So if you buy 1 unit, you pay 20% of the price of the product. So in this case, basically, a per unit tax only depends on the quantity you buy. An ad valorem tax depends on both the price and the quantity that you buy. Okay, or to put it differently, I can write it. I did not write it this way, but it could be quite interesting. So per unit tax is, or the amount you pay is a function of the quantity. Okay, only. And ad valorem tax, it's a function of how much you buy, of course. I mean, the total amount you pay, but also the price. Okay, so it could be, for example, 20% times the price times the quantity. And a per unit tax could just be $4 times the quantity. Okay, that's the difference. So here the price matters. Here it's a proportion. And here it's just a fixed amount. That's the difference. And we will mostly focus on specific taxes here. So I'll just show briefly what happens to the supply curve if we introduce an ad valorem tax, but very briefly. So, okay, we've already done that for the determinants of supply. So I'm going to skip this because I've already explained it all. And actually, I just copied the content of the PPT on the determinants of supply. So I don't think it's necessary to go through that again. But yes, the idea is that when you, I'll start with the diagram, when you introduce, if this is your market equilibrium, if this is your demand curve and your initial supply curve before the tax is introduced, so you have your market equilibrium. And if you introduce a per unit tax, a specific tax, okay, so it's a tax that is a fixed amount per quantity, it doesn't depend on the price. It's important, it does not depend on the price. $2 per pack of cigarettes, for example, then the supply curve is going to shift upward. It's okay if the students say it's going to shift leftward, but if we want to be more specific, it shifts upward by an amount equal to the per unit tax. So, which means the vertical distance between the initial supply curve and the final supply curve, the before tax supply curve and the after tax supply curve, is equal to the per unit tax that we've just introduced. And the consequence, of course, in the markets, we've not talked about that before, but this is obvious if we look at this diagram. The consequence will be an increase in the equilibrium price and a decrease in the equilibrium quantity. Okay, that is the effect of a per unit tax in a market. But something that is quite interesting is that before the tax, consumers paid $50. The price paid by consumers was $50. And $50 was also the price received or kept by producers. There is no tax. Consumers give me $50. I can keep everything. Okay. But when there is a tax, okay, so we have a new equilibrium price, $58. So this is the price paid by consumers. But this is no longer the price received by producers, or at least the price that producers can keep. Because producers, they initially receive $58 from the consumer, but they have to give $20 to the government, the amount of the tax. So they receive 58, but they have to keep to give $20 to the government. So how much do they actually keep? Only $38. Okay, so 58 is the price paid by consumers. 38 is the price received or kept by sellers or producers. And you see that, yes, the difference, $20, is the tax, of course. And you also note something interesting is that the price paid by consumers is higher than before. And this will always be the case unless the demand is perfectly price elastic, but that's a very special case. Okay, in almost all cases, if you introduce the tax, this will lead to an increase in the equilibrium price. So the price paid by consumers will increase. But at the same time, the price received by sellers decreases. They used to receive 50, now they only receive 38. Which means, and that's going to be very important when we talk about the concept of tax incidence, this means that basically they both suffer from the tax. Okay, it's not just the seller or not just the buyer. Consumers, they pay more than before, so it's a bad news for them. And sellers, they keep less than before, so that's also a bad news for them. Okay, so they are both affected by the introduction of the indirect tax, a specific tax, even if these are the sellers whose job is to give the tax to the government. So the burden of the tax is going to be shared between the buyers and the sellers, but we'll see that in a minute. It's a bit early, so we can summarize. Okay. So yes, equilibrium quantity decreases, equilibrium price rises. The introduction of the tax will create a gap between the price paid by consumers and the price received by producers. This is what I illustrated in the diagram. The price paid by consumers is higher than the price received by a producer, and the difference is the per unit tax. And yes, the price paid by consumers is higher than what it used to be before the tax was introduced. And the final price received by producers after the tax is introduced is less than the initial price they received before the tax was introduced. Okay, and this is precisely what this diagram illustrates. For an ad valorem tax, I have seen very, very few questions about that. So basically, the only difference between the introduction of a per unit tax and the introduction of an ad valorem tax is that instead of having a supply curve that is going to shift upward, but that is going to keep the same slope, okay, we can call it a parallel shift. In the case of an ad valorem tax, the supply curve will shift upward for the same reason as before, but it's also going to become steeper, more vertical. Why? If really to give the basic intuition, because the larger the quantity supplied, okay, if you move to the right, the higher the supply price, the price that you must receive to supply this quantity. Okay, if you, for a very small quantity of output, you would be ready to accept a pretty low price, low supply price. But for a large quantity of output, if you, in order for you to be able and willing to supply such a large quantity of output, you must receive a much higher price, which means that the value of the tax will be much higher because it's a proportion of the price. Okay, it's, for example, 20% of the price. So if the price is much higher, then the amount that you will have to pay in tax will also be much higher. So that's why the gap between the initial supply curve and the final supply curve, the after-tax supply curve, is going to be quite large. But at a low level of output, if quantity is very low, the supply price is very low, which means that you take a given percentage of a low price, so the tax is relatively small. So that's why there is a small vertical distance between the initial supply curve and the final supply curve. So that's what I explained here. So here you have the general explanation. And then, but again, I don't recommend you do it with your students. I created an example, this one, to prove it. Okay, with some simple data, with very simple data, I can show what happens when we introduce a 20% ad valorem tax on that product. And it's very easy to calculate the equations of your the equation of your new supply curve, and you would end up with something like that. Okay, that's your initial supply curve before tax. That's the after tax supply curve. So you see that it shifts upward, but it also becomes steeper, more vertical. And yes, I use data from my example to just show what happens, but it's a bit beyond the scope of the syllabus. The only thing that matters truly is to emphasize that the supply curve will shift upward, but will also become steeper, more vertical. So the gap, the vertical distance between the two lines increases as you increase output. Okay. All right. Taxes and demerit goods. I said earlier that one reason for which the government can collect taxes is to correct market failures, especially when the market produces too much. And this is exactly what happens when we are dealing with a demerit good. Yes, demerit goods are overprovided. Why? Because consumers ignore the long-term costs associated with their consumption. We say that they are myopic, they focus too much on the short-term costs and benefits, and they tend to overlook the long-term consequences of their actions. And because of that, they just demand too much demerit goods, and because the demand is too high, then the quantity, the equilibrium quantity is too high. So we have an overprovision. And in that case, the government can use a specific tax, a per unit tax. Actually, it could also use an ad valorem tax, but usually in AS, we focus on per unit tax because it's easier. If you introduce a specific tax, you can correct this market failure and restore efficiency, making sure that the right amount of resources will be allocated to the production of that good. Why? Simply because if you introduce a tax, the supply will decrease, shift upward in particular, and therefore the equilibrium quantity will also decrease. And if we choose the right amount, because that's what's tricky, if the government is able to identify what should be the right size of the tax, then the government will be able to enforce the optimal level of production and to restore efficiency. Students don't have to know that, but if you want to restore efficiency, if you want the market to produce the best quantity of demerit goods, then the tax should be equal to the marginal unforeseen cost. Okay, they don't really have to know that. But there are some problems, of course, and that's important when students write essays about government intervention, because of course they should be able to explain how each policy instrument works, how each policy instrument can correct a market failure, but for the evaluation, they should also talk about the limitations and the issues that we might encounter when using each policy instrument. So in the case of taxation, there are three main problems. First one is about information. As I said, we need to, the government must have a very good information to be able to identify the right size of the tax. If the tax is too small, it's not going to sufficiently decrease the quantity that is going to be produced. And on the other hand, if the tax is too large, then we're going to switch from an over provision to an under provision, and we will not restore efficiency. So that's one limitation. Another one is about the political interest. Taxes are not very popular. People don't like to be taxed. So if you impose a tax on alcohol, or on tobacco, on demerit goods, or even on fuel, people might be quite upset. And if you wanted to be re-elected next year, that might not be the best strategy. You probably heard about the yellow vests in France, which were a group of the population who basically demonstrated every Sunday for several months in France. And the original cause was the introduction of a tax. The government wanted to introduce a new tax on gas, and big fraction of the population was very much upset about it, and they started to start strikes and demonstrations. So again, governments, they also care, politicians, they care about their own interests, and that's what political economy is about. So they might be reluctant, politicians might be reluctant to impose taxes, even if they have the potential to restore efficiency. And finally, as I explained earlier, indirect taxes, they are regressive. So there is an equity efficiency trade-off. If you introduce a per unit tax on alcohol, yeah, you might restore efficiency, you might solve the problem of over provision, so you improve efficiency, but this is at the expense of equity, because most of the incidence of the tax is going to fall on low-income households. So this might be efficient, but this might not be considered fair. And again, that's why the yellow vests in France, they were very upset about this new tax, because they felt like this tax was mostly going to affect poor people. So these are three limitations that are worth mentioning in an essay. That's how you can represent it. So this is the diagram of a demerit good. So there is a gap between the perceived marginal benefit and the true marginal benefit. And well, that's the same diagram as we studied before, so I'm not going to make a comment about it. And yes, what is important here is that we have an over provision. The market produces Q1, but the best quantity, the optimal quantity, is Q star. So there is a deadweight loss, but the deadweight loss is not a concept that is that students are expected to know in AS. So what can we do if we produce too much? We can simply introduce a tax, okay? So if we introduce a tax, then the supply curve is going to shift upward by the amount of the tax. And you see that the new equilibrium quantity, well, supply is equal to demand, is going to be Q star, okay? Q2, which is the new quantity provided by the market, is equal to the optimal quantity. So if you want to achieve that, you need to make sure that the tax that you introduce is equal to the marginal unforeseen cost, which is the vertical distance between your perceived benefit and the true benefit, of course. Okay, so decrease in supply, decrease in the equilibrium quantity. If the tax has the right size, then you will restore efficiency. Pretty easy, pretty straightforward. Okay. Now, the big part that we have left, that is left, then we'll say a few things about subsidies, but very briefly, because I just copied the content pretty much and just replaced what was necessary. So I will mostly, I will go very, very quickly. I will talk very, very briefly about subsidies. So tax revenue, how much is going to be collected by the government? Okay. How can we calculate it? It's basically the per unit tax. We focus on per unit taxes, okay? I'm not talking about ad valorem taxes. So if we introduce a per unit tax, the tax revenue is the size of the tax multiplied by the final quantity. So final quantity is how much has been purchased or how much has been sold after the tax is introduced, okay? If you don't like final, you can replace by after tax quantity. It's important to be precise, because there is always an equilibrium quantity before the tax and after the tax. So I wanted to emphasize that, yes, this is the quantity traded after the tax is introduced. Okay, and something that is quite interesting is that if you have a demand that is very, very inelastic, then the tax revenue is going to be higher. Why? Because in that case, even if you introduce a tax, people will still buy the product. Even if the price rises, people will still buy the product a lot. There will not be many consumers who will reduce their consumption, or perhaps they will just reduce their consumption a little bit, which means that the government will still be able to will collect the per unit tax on many units. On the other hand, if you have a demand that is very, very elastic, and if you introduce a per unit tax, the equilibrium quantity will fall a lot. There are many consumers who are going to stop purchasing the product. The consequence is that the government will be only able to collect the tax on a few units, okay, those who still buy the product. And that's actually maybe one reason for which governments, they tend to impose taxes on products that have very inelastic demand, and usually demerit goods. Yeah, well, fuel, because it's a necessity. So if you impose a tax on fuel, people still need fuel. So they still buy a lot and you make a lot of money. Tobacco, because it's addictive, alcohol, because these are habit-forming products. So that's a good question. Do governments impose taxes on tobacco or alcohol to discourage consumption? Or simply because they know that the demand is so inelastic that people are still going to buy those products, and that this is a good way to make money, to collect tax revenue? I don't have the answer, but it's interesting to ask the question. Okay. What we call the tax, the incidence of a tax, and I've already started to introduce it. If we go back a bit, you remember this diagram. We saw that once we introduce a tax, a per unit tax, consumers are going to pay more than before, and sellers are going to receive less than before. So the idea is that the tax is not only going to affect either the buyers or the sellers, the tax is actually going to affect both. So it will have an incidence on consumers, and it will have an incidence on producers. So basically, the incidence is basically to what extent you are made worse off by the tax. So consumers are made worse off by the tax, producers are made worse off by the tax, and the amount or the extent by which they are made worse off, we call that the tax incidence on consumers and the tax incidence on producers. Okay, so yeah, the incidence of a tax is the distribution of the tax burden between producers and consumers. Okay, and then I explained that. That's just what I explained. Okay, the tax incidence on consumers, it's the burden on consumers. The tax incidence on producers, it's the tax burden on producers. Easy. Okay, let's just keep that. Boom, boom, boom. So this is the same diagram as before. Okay, so 58 is the price paid by consumers. 38 is the price received by producers. The first thing we can do is to identify the tax revenue. So remember, the tax revenue, how much has been actually collected by the government, it's just the per unit tax, so $20, which can be represented by this segment from 38 to 58. That's my per unit tax, how much I collect on every unit sold, multiplied by how many units I actually, or how many units are actually sold after the tax is introduced. Okay, so we should not multiply by 100, because after the tax is introduced, only 80 units are being sold. So the tax revenue is just the product of the per unit tax and the after tax quantity. So it's represented by this rectangle. But what we can do now is to be a bit more precise and try to identify, all right, so this is the tax revenue, but how much is going to be paid, even if it's not really paid financially, but borne by consumers, and how much is going to be borne by producers? Well, and that's quite easy to tell, because we see that initially consumers, they paid 50, now they pay 58. So every time they buy a product, and for those who still buy the product, okay, those 80 consumers, for example, every time they buy the product, they have to pay $8 more. Okay, so if you multiply $8 by the 80 units that are still purchased by consumers, you get the tax incidence on consumers, the extent to which they are made worse off by the introduction of the tax. And you can do the same thing with producers. Before the tax was introduced, each producer received $50, okay, and now they only received $38, which means that every producer who still supplies the product, okay, so we have still 80 producers, for example, they receive $12 less per unit. Okay, so if you multiply $12, this vertical segment, by 80 units, you have basically the impact, the negative impact that the tax has on producers, and we call that the tax incidence on producers. And you see that if you add the tax incidence on consumers and the tax incidence on producers, well, you get your tax revenue. Okay, it does not mean that consumers, they pay directly the green amount to the government, and the producers, they directly pay the blue amount to the government. Okay, this is not what it means. It's just the burden of the tax, the impact of the tax on their welfare. Okay, and here you see that it's almost 50-50. a bit more for producers, but not much, maybe 60% for producers and 40% for consumers. So that's relatively equally shared. This we can skip. It's an exercise where they can actually calculate it, but of course, this is definitely beyond the scope of the syllabus. It's not necessary for your students to complete this exercise. If you want to do it for fun, sure, but it's outside the scope of the syllabus. Now, what we have to understand is that basically, how do we know if the tax is mostly going to have a negative impact on consumers, or whether it's mostly going to have a negative impact on producer? And the answer is that it depends on the price elasticity of demand or of supply, both, okay? It depends on the extent to which demand is price elastic relatively to supply. Okay, or equivalently, the extent to which supply is price elastic relatively to demand. Okay, so it's not just demand or just supply, you compare both. Okay, so we will look at whether demand is more elastic than supply, or whether supply is more elastic than demand. Okay, so to keep it very simple, we will basically look at which curve is the flattest. Okay, if you have a very flat demand curve and a very steep supply curve, then demand is relatively more elastic than supply. And if you have a very steep supply curve, if you have a very flat supply curve and a very steep demand curve, then supply is relatively more elastic than demand. Okay, so it's not just one or the other, it's a comparison between the price elasticity of demand and the price elasticity of supply. And yes, the key idea is that the party, so buyers or sellers, or the type of agent, buyers or sellers, who is the most insensitive to price changes, who has the most inelasticity, or the greatest price inelasticity, is the one who is going to bear most of the tax. I repeat, the party that is the less sensitive to price changes, more price inelastic, is the one who is going to bear most of the tax. And the party who is relatively more sensitive to price changes, more price elastic, will be the one who will bear the smaller amount of the tax. And why? Why is this the case? Well, simply because, and we can see that graphically very easily, if demand is very elastic relatively to supply, then the price paid by consumers is not going to increase very much. But the price received by producers is going to fall very much. On the other hand, if demand is very inelastic compared with supply, then the price paid by consumers is going to increase by almost the full amount of the tax. So it's going to increase a lot. So it's very bad news for consumers. But the price received by producers is going to decrease just a little bit. Okay, so that's why if a party is very sensitive to price changes, it's not going to be very much affected by the tax, because the price it pays or the price is received is not going to change much compared with the situation before the tax. That's the basic intuition. Then you have plenty of diagrams, because I've considered all cases, and you even have extreme cases. What if demand is perfectly elastic or supply is perfectly inelastic? Then the tax burden is not shared between buyers and sellers. The tax burden is going to be borne entirely by only one party. So for example, if demand is perfectly price elastic, then the entire tax will be borne by producers. Same thing if supply is perfectly price inelastic. On the other hand, if demand is perfectly price inelastic, then buyers are going to borne the entire tax burden. Same thing if supply is perfectly price elastic. And then you have all possibilities. So look at this one, for example. So this one, clearly, we can simply look at the slope, right? Supply is more elastic than demand. It's flat, demand is steep. And you see that in that case, because supply is very elastic, sellers, they bear just a very small burden of the tax. The tax incidence on producers is very small, and buyers who have a relatively more price inelastic demand are going to bear most of the tax incidence. So it's no longer 50-50. Why? Because you see that because demand is very price inelastic, the price paid by consumers has increased a lot from P1 to P2 by almost the entire amount of the tax. So they are really made worse off, but the price received by producers has only decreased a little bit from P1 to P3. So this has not had a big impact on producers. This case is the opposite. You see that demand is very flat, price elastic, supply is steeper, price inelastic. So demand is relatively more price elastic than supply, which means that when you introduce the tax, the price paid by consumers only increases a little. So consumers are not really made worse off by the introduction of the tax. However, the price received by producers decreases a lot from P1 to P3. And therefore, this has a very negative impact on producers. So most of the tax is effectively borne by producers. Okay, and then you have extreme cases where demand is perfectly elastic. So all tax is borne by producers. Supply is perfectly inelastic. So again, all the tax is borne by producers. And then you have the other cases. Demand is perfectly price inelastic. So the entire tax is borne by consumers. And the last case is supply is perfectly price elastic. Sorry, supply is perfectly price elastic. And so again, the entire tax is borne by consumers. But honestly, these extreme cases are not very interesting. I represented them because I wanted to have all cases. So you can refer to any diagram you may want to use with your students. But I think it's more important. Usually in class, I just show these two, this one and this one. I think it's enough to make your point. Okay, I think that's it for taxes. And as I told you, we can also talk about subsidies briefly, but that's going to be very quick because that's just subsidies are just negative taxes. So yeah, I think in 15 minutes I can be done, maybe less than that. So subsidies, what is a subsidy? It's just an amount of money granted to a beneficiary. Usually it's a firm. Okay, we don't really give subsidies to people. We can give some benefits, yes, but when we talk about a subsidy, it's usually to producers by a governmental organization. All right. Why do we give subsidies? Could be that we want to make sure that the market price remains low enough, especially if the product is a necessity, like basic food stuff. Could be to, as we're going to see, to encourage the consumption or production of merit goods and goods that generate positive externalities. But for positive externalities, we'll see in A2. But we'll see briefly how we can use subsidies to restore efficiency when there is a merit good. Could be to guarantee a minimum income for certain producers. Okay, because if you introduce a subsidy, the price received by producers will increase. For example, farmers. And this could be to improve international competitiveness, to keep the market price as low as possible, not because it's something essential for your population, but because you want to gain market shares abroad. You want to boost your exports and you want to discourage imports. These are the main reasons for which governments give subsidies to businesses. And yeah, I really emphasize that subsidy is just a negative tax, so there's actually nothing new. Introducing a subsidy actually has the same effect as reducing a tax. I repeat, introducing a subsidy has the same effect as reducing a tax. And introducing a tax has the same effect as reducing a subsidy. Okay, so yeah, it's really the same logic. All right, so then again, I just copied what I had before on taxes for the impact. So I can just move to the diagram because that's really the same thing. If this is my initial market equilibrium, I introduce a subsidy. So the supply curve shifts downward by the amount of the per unit subsidy. Okay, $20 here. So we have a new market equilibrium, lower market equilibrium. So the price paid by consumers decreases. Good news for consumers. Also, we can note that there is a higher equilibrium quantity. So that's why we can use subsidies to increase the consumption and production of merit goods and fix the problem of under provision. So yes, 50 is the price paid by consumers. The price received by producers is actually there, 70. So because of course, every time this a firm will sell one unit, it will receive $50 from the consumer, and it will receive $20 from the government. Okay, so 50 plus 20, 70. So you see that the price received by sellers increases from 58 to 70. So that's a good news. The subsidy is a good news for buyers, but it's also a good news for sellers. And just like taxes, but we are not going to talk about that. This is not tested in AS, but we could really do the same thing. Like we could distinguish the subsidy incidence on consumers and the subsidy incidence on producers. And guess what? I have done it. So if you look at the end of this PPT, you have information about the subsidy incidence and how the relative price elasticity of demand has an influence on the how the benefit of the subsidy is shared between sellers and buyers. Okay. So yes, remember merit goods, the problem we have, because yeah, it's a problem, we don't consume enough. We don't produce enough, we don't consume enough. Businesses do not allocate enough resources to the production of merit goods because people do not demand enough merit goods. They are myopic, they ignore the long-term benefits associated with the consumption of merit goods. So we have an under provision, and we can use a specific subsidy to fix this problem. Why? Because we just saw that here, if we introduce a subsidy, the equilibrium quantity rises. Again, we have to make sure that the subsidy we introduce has the optimal size. If it's too small, we will still have an under provision. It might be less than before, but we still have a problem of under provision. But on the other hand, if the subsidy is too large, then we will end up with a problem of over provision. And again, if we want to restore efficiency, if we want the equilibrium between supply and demand to provide the optimal quantity of merit good, then the subsidy should be equal to the marginal unforeseen benefit, okay? Which is blah, 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 okay, which is there, okay? The gap between the true marginal benefit and the perceived marginal benefit, the benefit I see, and the true benefit associated with consumption, okay? The gap is what I do not see, mostly because this is a long-term benefit that I ignore when making my consumption decision. And yes, if I want to restore efficiency, because clearly the market produces Q1, but it is optimal to produce Q star. So yes, we have a deadweight loss again. And if I want to restore efficiency, I can introduce a subsidy whose size should be equal to the marginal unforeseen benefit. You see that the vertical distance between the green line and the blue line is the same as the vertical distance between the red line and the orange line. Okay, subsidy is equal to the marginal unforeseen benefit. In that case, yes, we see that the new market equilibrium quantity Q2 is equal to the optimal quantity. So we have corrected the market failure, and the market now produces the optimal quantity of merit good. But just like taxes, there are some problems that we should be aware of, especially when we write an essay question about market failures, and there are many essay questions about that. So I have I focus on three main limitations because usually it's enough. Just like taxes, there might be a problem of information. It might be difficult to identify what is the right size of the subsidy. Just like before. They might be, in the case of subsidies, they might also be conflicting objectives. Because of course, if you want to give subsidies, you might have to collect taxes to fund those subsidies. Okay, if you give money to people, this money has to come from somewhere. So it means that you have to use tax revenue. You might have to increase taxes if you want to increase subsidies. So if your objective is, if you have a, if one of your objective as a government is to lower taxes, perhaps you got elected and you promise to reduce taxes, and at the same time you want to give more subsidies, there might be a conflict. You might not be able to give more subsidies and at the same time keep taxes at a very low rate, unless you accept to increase your budget deficit. Okay, that's why I talk about deficit. And careful here, it's not, maybe not clear in my PPT. I don't mean a trade deficit, I mean a budget deficit. Okay, the budget deficit for the government. So if one of your objectives is to reduce budget deficits and at the same time you want to give more subsidies, this might be in conflict. Okay, so yeah, that's a problem with subsidies. The money has to come from somewhere. So you might have to increase taxes, or you might have to accept to increase your budget deficit. Might be a problem, because you have to borrow money, you have to pay more interest payments on your debt, blah, blah, blah. And finally, there is something that is a bit specific about subsidies, is an observation that after you have, once you have first introduced a subsidy, it's quite hard to remove it. If you introduce a tax and then you say, all right, let's remove it, everybody will be happy, right? So people will not fight it. It's actually very hard to introduce a tax, as I mentioned, because they are not popular. So it's hard to introduce, but it's easy to remove. A subsidy, it's the opposite. It's very easy to introduce. Everybody's happy if, when they receive money from the government. But then if economic conditions have changed and if the subsidy is no longer required, or if perhaps you consider that you can no longer afford it, you want to lower taxes, or you want to reduce your budget deficit, it might be very hard to remove the subsidy, because again, people will be upset, businesses will be upset, they might have become dependent on the subsidy, maybe they will not be competitive enough anymore if you remove it. So they might go bankrupt, they might have to lay off some employees, they might lose market shares abroad. Okay, so basically there is a problem of irreversibility, which means that once you introduce a subsidy, it's likely to be there in the long run. It's going to be very hard to remove it after it has been first introduced. And therefore, governments, though politicians, might be reluctant to introduce subsidies in the first place, because they anticipate that if they want to remove it later, it's going to be very hard. All right, so the diagram, I already explained it. And then the rest is not very interesting. Well, it is interesting, but it's not required for your AS students. Maybe the subsidy expenditure, just like you can identify the tax revenue on a diagram, you can also identify the subsidy expenditure, which is basically the total amount that is paid by the government when you introduce a subsidy. And okay, which is there, right? If this is your initial equilibrium, E1, you introduce a subsidy, so your new market equilibrium is E2, so you now trade 100 units, and this big rectangle is the subsidy expenditure. This is the amount that the government will have to pay to businesses after introducing this subsidy. The per unit subsidy is $20, and 100 units are traded, so this big rectangle is the total amount paid by the government. I think that's the only thing that can be tested. I think I have seen one MCQ where students had to identify the total amount paid in subsidies by the government. So they can simply use this formula, okay? And then the subsidy incidence, I have never seen anything in past papers, correct me if I'm wrong, but I've never seen any question where students have to identify the subsidy incidence on producer, the subsidy incidence on consumers, to discuss the importance of the PD and the PES, to determine who's going to benefit the most from the introduction of the subsidy. But if you are curious, if your students are curious, I have prepared slides on that, but you see the one step further star that suggests that you can skip this. But again, I have represented it, okay? SIP, subsidy incidence on producers, careful, now it's on top. And SIC, subsidy incidence on consumers, now it's on the bottom. And again, it is influenced by who is the most sensitive to price changes, buyers or sellers. So here you see, for example, it's mostly consumers who are going to benefit from the subsidy because they are the less or the least price sensitive. So it's the opposite of the tax incidence. And producers are not going to benefit greatly from the subsidy because they are very sensitive to price changes. So the price they receive after the subsidy is not much more than what they received before. Okay, and that's it. Yeah. Do I have another case? I thought I had another case. No, I don't even have another case where it's the opposite. Maybe I should represent another case where I show where if demand is very elastic and supply is very inelastic, I could show that in that case, firms would be the ones benefiting the most from the introduction of the subsidy. Wow. Again, this is definitely one step further. I have never seen any question that requires knowledge of that particular content. Okay, so let me just again show you the documents that you can find. I think they are still on my desktop. So yes, you have a summary of taxes and subsidy. Everything is already available on the website. Okay, so a lot of definitions, you see, only 8 pages. Well, only 8 is a lot, but this is a very big topic, right? 8 pages also because there are many diagrams. Okay, look at all these diagrams. So that's also why it's, and the last page is pretty short, yeah. So pretty concise. You have a list of, where is it? Definitions. 3 pages, there are quite a few definitions here, okay? Everything that relates to taxation and taxes and subsidies. And the concept cards, I think they are in a different folder. Yes, the concept cards are here as well. So let's just have a look at the drawing challenge. Your students will have to represent Pumbaa, which is is this some kind of a pig in Lion King? Yeah. And you have, of course, the student version of the PPT. So the teacher's version has, I'm almost ashamed to say it, 238 slides. The student version only has 57. So that's still a lot, but we've saved some trees, right? you better print this version than the other one. And actually, you might not even have to do so if your students are comfortable working with the electronic version of the PPT. Okay, any questions? Thank you. Thanks for the feedback. Yeah, I like this topic. I like this topic on taxes and subsidies, and yeah, I'm quite happy about the resources that I developed for these particular topics. There are some topics for which I don't really like my PPTs, but yeah, this one is all right. So no workshop next week. It's the holiday, happy holiday. And Wednesday in 2 weeks, we will have our last workshop because I will not continue, I will not schedule additional workshops on macroeconomics, at least not for now. So we'll have a last AS workshop on price control, maximum and minimum price, and other policy instruments. And for the A2 class, same thing, no workshop next week. And Tuesday after the holiday, we'll have one workshop on monopoly. We've completed perfect competition. So after the holiday, we'll look at the second market structure monopoly. Okay, thanks for joining me, Nas, tonight, and have a nice evening, and see you after the holiday. Bye-bye.
Thanks. Good night.